Are you a fan of the two acquisitions?
I am. So, when you look at the hydrogen space and you look at motive hydrogen, Plug is far and away the leader in terms of experience. They've got over 1 billion miles of data on their systems, having entered into the material handling market where there's a compelling set of economics for their solutions. And so when we look at these recent acquisitions, they're focused on two things. One, leaning up the hydrogen supply chain for their customers, so actually streamlining that, but then also reducing the cost in a very material way. And so the United Hydrogen Group acquisition allows them to control their platform for delivery and logistics around hydrogen. But then the Geiner ELX acquisition really is an essential piece of their cost reduction strategy for hydrogen production. So we're actually very bullish on these two acquisitions and on the impact of Plug's economics.
It's Karen. Let me ask you a question, Colin. How big is their addressable market? If you want to be really bullish on it, and it sounds like you are bullish, where are we going to see revenues maybe 2 or 3 years from now?
So the company's highlighted, a target of $1.25 billion in revenue by 2024. $750 million of that will come from the material handling market. $250 million they're looking at the over-the-road market, and then the other $250 million will come from the hydrogen business. Now, when we look at what's going on, broadly in the transportation sector, I think one of the most interesting areas is really in the last mile and middle mile, vehicle transformation. We're seeing different fuel sources leveraging off of different applications, and we're seeing, the move towards hydrogen coming out of warehouses, where Plug actually has, a fair amount of infrastructure in place for fueling. Into new routes, new vehicle design for different applications, and certainly it's going to take some time, and so we think that'll take 2 to 3 years, but it's very much underway and really being driven by what's going on in terms of the delivery market right now.
Hey, Colin, it's Tim. Thanks for joining us. And again, maybe I'm thick, but I'm just still trying to understand why now for hydrogen cell technology. And I realize that having the infrastructure and the ability to service and fuel these cars is a big part of it. But this has been a long time in waiting. And has it been driven by the adoption of EV? Or, help us understand why we're hearing about this now, because it almost seems as if just as you're getting EV mania is only when you started to hear about hydrogen coming into play.
It's an important question, and one that I think is sometimes misunderstood. So that the actual motors and much of the electrical infrastructure in an EV is actually highly leverageable for a hydrogen fuel cell as a power source. And so many of these vehicles are going to end up being hybrid vehicles where you've got batteries and a fuel cell integrated in them. But the basic platform, separate from the power source, is actually entirely common. And so the advent of growth in EVs is actually enabling cost reduction for the hydrogen vehicles for the balance of the vehicles, and it's really offering up an opportunity for buyers of these vehicles to diversify their fuel source.
Hey, Colin, just a last quick question here. You've got an outperform rating on Plug and an $8 price target, and the stock is almost at $9 at this point. We've seen this sort of mania hit this corner of the market, and I'm wondering how much froth do you think there is in sort of this EV space?
It's an important question and something that we're playing catch up on this. Across the sector, these stocks have moved so aggressively and so quickly on some of the strategic moves that we've been bullish on. Whether it's Plug or Tesla or some of the other names that we cover. And I think there's a couple of things that we're pointing to. Is one, the impact of low interest rates inflating these assets. Two, the fact that many of these EV and newer technology startups in the hydrogen space actually are fairly well capitalized relative to what's going on with the traditional automakers, which are highly levered at this point at commonly 80 to 85% levered on their balance sheets. And so they're going to have to go through restructuring, and what that's allowing for is an opportunity for accelerated growth for some of these newer technologies, especially as some of the bigger buyers of vehicles in the transportation market and the logistics space are looking to go to zero-emission vehicles. And it's really an environment where you could see, better than expected growth. Now, in terms of valuation, I think the entire market is figuring out what's overbought. and what's underbought right now, we're expecting a very volatile third quarter here from a trading perspective. Even though the recovery's been a little bit better than expected in 2Q, or the sell-off has been better than expected in 2Q from a fundamental standpoint, the recovery over the long term is still uncertain for us. And so we're expecting it to be a very volatile environment and to see some of these spikes and retrenches. So I think it's a good time to be a tactical trader.
Colin, thank you. Colin Rush of Oppenheimer. Guy, what's your bottom line on this?
So, Darren, I think Colin answered all your question in terms of the fundamentals of this company. So let's answer your question in terms of trading it. You said you've watched it go from 3 to 9. Now it's, I think, an $8 stock. At a certain point, you just got to immerse yourself in it. So if you buy 10 to 15 shares, then you're in the game. Then you're going to really watch it closely. So I can't tell you where it's going tomorrow, but get yourself in the game. Start a position now. Barclays actually just downgraded the stock but put a $10 price target on it. So I think those are the types of things you're going to be seeing. But you got to get in at some point, and I apologize about Flip barking.